Be happy for what you have. Exactly. Always be thankful. Okay. I like that. Okay. So, private markets. Let's think about this. What are the private markets? So, public markets, we talked about Macy's, Nordstrom. Private markets, not public, meaning you can't buy stock in these companies. They're privately owned. They have shareholders. They have founders. They have people that have invested in them. I invest in the private market. I invest in companies in private markets. That's what I do for a living. Now, what is private equity? Private equity is a fund. They have money from investors. They take that money from investors and they go and they buy businesses and they operate those businesses. Is that clear right there? Simple. Okay. Where does their money come from? Their money might come from pension funds. Their money might come from school endowments. Their money might come from wealthy people, right? They are typically going to be investing in the private equity fund. They give them money. Here's a $100 million check, literally. And then they say, okay, in 5 years, we expect to get you back 20% a year on that money, or 10% a year on that money, or whatever the number is, right? There's some sort of hurdle rate, something that we have to achieve to give you your money back, a rate of return from the investor's perspective. They are then going to go take that money and try to get returns on it, right? So this is how that kind of game is played. What is leveraged finance? Leveraged finance is the debt that supports the private equity acquisition. Do you all remember the house story we talked about? Buy a house with 20% equity and 80% comes from Wells Fargo. Okay. Instead of Wells Fargo, it's a fund. It's a bank. It's Jeffrey's leverage finance team. They have a first lien team. One of my coworkers just came from Jeffrey's and works with me. He made a debt investment. So he's providing capital, providing debt to private equity companies to make the acquisition, right? So again, so this is Wells Fargo giving you money to buy a house. This is some fund or investment bank giving you money to make an acquisition, okay? This is high yielding debt, meaning something that we talked about, these spreads, 7%, 8%, 9%, 10%, high interest paper to use to make the acquisition. The banks, the large banks, are not going to provide this. I mean, it's a risky investment because they're buying a business and it's operating business and there's risk. What is a blanket risk to all companies? Economics, the economy, right? So if you make an investment in the company, you're a debt investor, you want to get 7% back in interest, the economy collapses, the company's not going to perform, right? So there's just a general economic risk. There's also no Fannie Mae and Freddie Mac going to be buying mortgages to help support mortgage companies and mortgage servicing businesses. So a little bit different there as well. What makes one security riskier than another? We talked about that already. Why do market participants require more return for equity than debt? We talked about that. And what makes one company more risky than another? We talked about that. So this is good because typically, I think the last time I did this, we didn't talk about any of that until we got here. But we've kind of covered all of that. Is there anything here that anyone wants to answer, feels confident in answering, or wants me to clarify? Anything? Okay.
Well, no. You'll probably later on.
Okay. Okay. So this is what is private equity. I'm going to just wait. No, don't really have to worry about this. But private equity fund is limited partners, so they own shares in the fund, and then there's general partners who really have the full liability. And this is the latter is responsible for executing operating the investment. The GP, right? The fund itself has to make the investment. They're going to execute and operate the business. All right. There's a lot more nuance to it, but we're going high level here. Okay. A simple LBO. You all have a document. It's called Simple LBO. And let's just work through it to get the mechanics. All right. So let's open that up, the Simple LBO file. Just so we can kind of get the mechanics here. Just let me know when everybody's there. Everybody there? Yes? Good? Okay. So, what's going on here? This is the use of funds, meaning we're using money to make an acquisition, okay, at the top. Source of funds, what type of financing are we using to make an acquisition? All right, so we're just gonna do this. We went through the EV to EBITDA, so we're gonna kind of calculate that as well. And then the exit assumptions. How are we gonna exit, what sort of returns we can get? Okay, so let's say, this is where I got to put our thinking caps on a little bit. If we paid a premium of 30%, all right, so 30% premium, that's C4, premium paid, 30%, all right? We have our shares, right? And we have our offer price, current offer price. We shouldn't call it offer price, but let's call it the current price. 25 is the current price. And we have 2 million shares. We want to pay 30% above that. That's what we want to offer, 30%. What is the buyout of the equity that we have to buy? How does the math work out? We're going to do equals, right? 25 times 1 plus, right? This is us growing this, right? We're growing that. Does everybody get that math right there? We're growing it by 30%, right? And what's our last piece for the equity? We got the price, we got the premium. What's the last number that we're missing here? We're thinking about shares, exactly. So what's our equity value? Right, okay. And now, remember we talked about debt. So what else was included in the enterprise value? Debt, right? So we need to buy out what? The equity and the, exactly, because we're buying the whole, exactly. And the whole company, Joe, enterprise value is? We're buying the whole company. Joe's never going to get that question wrong again. So we're going to pay $68 million for this business, right? Okay, great. So we have 68 million here, right? That's all the equity. How are we going to finance that? Let's just start thinking about it. How would you guys finance this thing? We're not knowing anything else. Do we want to use more debt, less debt? What did we learn about debt, leverage, these things so far? Come on.
I'll say like 10 million debt.
10 million in debt? Okay, let's just go with 10. And then all right, forget cash right now. We're not going to worry about the cash balance. So you use 10 million of debt. So you're telling me then, where's the 58 million come from? So what are our sources of financing here? Yeah.
This is where you go to your fund and say, hey guys, I have this, blah, 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 right? And this is where you get your money from.
Yeah, if they want to buy it with cash, right? The 10 is coming from our debt. Exactly. And we're getting that where? Somebody else, right? Me. This is me. All right, I would do this. I'm that number. I'm going to come in with our fund. That's what we do. We provide debt financing for a deal like this. Now, though, if you use 10 million of debt and all that cash, when you pay off that debt in the future, right? So you're going to pay it off. You're left with equity, right? But now, if you were to buy a mobile home, they own. Would you rather, if I told you that mobile home is going to pay off all that debt and leave you with $150,000, right? Would you rather, let's say it's $20,000 today. Would you want to just finance it with all debt, right? And let's say you can make a great return on that, or would you rather use your own cash? you would use the debt, right? But in his situation, why are you using such little debt? It's okay. I just want to get you thinking. You'd use the debt, right? We want to finance this at least more debt. Why? Because of leverage. If you think about it, we have cash. We're a fund, like Aaron said. We have money. We're going to put a stake in the business. But we want to use debt to leverage our returns. It's called leveraging returns, right? You're getting multiple in your cash. Because if you have equity, if we financed it with $30 million, the business itself is going to pay down that debt over time, right? And we are doing what? We're improving the business. We're finding synergies. We're creating margin expansion. We're finding revenue for this business. So we're going to make this business worth more in the future, right? When the business is worth more and our debt is paid off, what is your equity technically going to be worth then? More, right? Because the debt should say that the debt should decline. Maybe I should just do it this way. Maybe it's a little bit easier. Let's say you paid your EV, you paid 100 million day one. Your debt, we did it 50. Right. Right. Okay, but this is what I'm saying. Now this is today. Tomorrow, or let's say 5 years later, we doubled this up, right? And we paid all this off. So now your equity is worth 200 million. This is a leverageable return, right? You're actually paid off all the debt now. If you use all your cash up front, your return, you put out, let's say, instead of using, let's say you did all, you put out 100 million, you're going to get back 200 million, right? But if you only put out cash of 50 million, you're getting back 200 million, right? So what's your multiple on your equity? You invested 50 day one, you got 200 at the end. 4x, all right? 4 times. If you paid all cash for this, you put out 100 million and you got 200 million, what's your return? So do you want 4 or 2 times your money? Obviously 4. Exactly. So this is the business model of private equity. This is what they're doing, right? They're using debt to finance an acquisition, just like use debt to finance a home. They have different levels and things, but this is, right? So now return, if you think about return, this is called cash on cash. Simple. We put out, or we got back 200. Okay. Right? Same thing. Does everybody see that? Maybe I should put it side by side. Okay. Does everybody see that? Everybody see the math works out? For anyone who doesn't understand what just happened. Somebody log off.
They can't hear.
They can't hear?
If you're a little closer, I can move that.
Oh yeah, no, you're right. I should move over here. This is better. Okay, let me move over here. This is better. Does everybody see that? I don't even know if Zoom is seeing this right now. They are. Okay, good. So does everybody see those returns? Does everybody see the leverageable returns? I feel like you're not. Convince me otherwise.
More debt, the more return.
Right. I mean, because it.
Don't have to.
Oh, I guess it doesn't work. How about that?
Yeah.
More debt, more return, right? This is leverageable equity. We're putting a little bit of money in to get big returns out. In this situation, we're putting more money in and we're getting a lot less out. Does this make sense? Everybody gets it? This is just basic private equity math, right? We're not going to get into nuance, just concepts. All right. So now we said 10 million. What do you think now is a better way of looking at this? What are you thinking about now instead? after we just did that exercise.
You give more time.
Okay, how much? Now you're the lender though, what do you think, what are you comfortable with? 25? Okay. So at 25, what's that?
34.
34, so you want to give half. Okay, so we're going to go with that 34. Why? The lender knows it's a market. Private equity funds don't deal with one fund. They don't deal with one lender. They deal with many lenders. This is a auction, you would think of it as. They're calling many lenders and saying, hey, this is what we want to do. There's diligence that gets done. So this is what I do, right? I get information. Hey, we got this person, they want to buy this company. They give me all this information. I'm going to build a financial model. I'm going to have to ask them questions. It's a multi-month process, talking 6 months, 4 months, this goes on. While I'm doing it, there's probably 4 or 5 other funds. And everybody's trying to position themselves as the right partner. You should do it with us because there's reasons why we're better than the other person. And then, of course, there's terms and things. So we're going to kind of go through this. Terms meaning, what's the interest rate? What's the amortization? What's the excess cash flow? So we paid 68 million, right? So I want you to do this on your own. We're paying 68 million, and our EBITDA is 10, right? What is our EV to EBITDA multiple of this? You can calculate it yourselves. What's that? What's the EV to EBITDA multiple we're paying for this business? The EV to EBITDA multiple that we're paying for this business. You could do it with a mental math, right? You even have to calculate it. Huh?
No, 6.8.
What is it?
6.8 times.
6.8 times. And what did you do to get that?
6.8 times.
Right. Fair? Everybody got it? Anybody have any questions? No? Okay. So let's say, what formula would you put here? Let's say that let's say EBITDA grew
What did you get the 6.8?
sure, right here. Because we had to take this 68 is what we paid for the business, right? We used debt and we used equity. We used 34 million of debt, right? And 34 million of equity to purchase $68 million of business, right? This 68 is just divided by our EBITDA is 10. So our multiple 6.8 times. Okay. Now let's say EBITDA grows 50%. So how would you do the math? How would you do it formulaically? What would you do? Like walk me through a formula. 50% growth. How would you do that?
So if that's 1.5.
That's it. So now, if we assume that we will never take less of a multiple than what we paid for the business, we're getting back in the future, how much? 5 years later. What's our new enterprise value? 102 million. And all the debt paid off, right? And there's no cash left over. We're just avoiding cash because it only confuses people. Our equity left is, and how much did we put out day one, Aaron? Exactly. So what did we make on a cash on cash return? What was our cash on cash? Put out 34. We got back 102. So what mental math? Give me a round number. 102 divided by 34 is 3-ish. Yeah. We'll call it 3.3 times our money. And what is that in equity IRR? An internal rate of return. What's internal rate of return? Anybody know? It's just kind of what your annual rate of return would be. An annual rate of return. If I told you that, and just annualize things, like if I told you that some mental math is always good, important. If I told you somebody made 30% on their money in 6 months, 30% of their money in 6 months, what do you think the annual rate of return would be on that money? Just mathematics, huh? 60%, right? Just doubling. If I told you somebody made 30% of their money in 3 months, what would be their IRR? Huh?
Their IRR.
Yeah, 120, right? So if you get the math here, so over 5 years, our 3.3 times our money gave us an approximate 25% a year on our money. And what did we talk about private equity returns are like? 20 to 30%, right? So we just like first try, we were good right out of the box here. Let's just work. I keep walking away from this. I apologize to the Zoom people. I keep walking away. It's just easier to talk on that side than this side. Now let's look at how debt financed this. What if we brought this down up to 50 million? What happened to IRR now? Right, and why did it go up? Our own cash, right. So what if we did 10 million, as Ash wanted to do earlier? 12%, right? And you're fired as a private equity manager. Because I'm a different private equity manager. I got my investors 41%. And what did you get? Right. So you're much worse than me. Yeah, I'm just kidding. All good. So obviously you can all see this now. Is it conceptualized a lot better for everyone? They can see the IRRs, you can see the cash on cash returns. Aaron, anything? Joe? Terrence? Anyone? Good?
The crazy thing about the private equity is it literally isn't even like a loyalty thing. Like I've seen that, like, my first thing in the business was working with someone in this, and the people that invest with you that month, if somebody's gonna get it more, they don't care. Like it's like, what can you do for me right now?
Right. So private equity, it's an interesting model because there's a lot of private equity firms, number one. A lot of it's relationship, or a lot of it is their ability to grow earnings. How did they grow that EBITDA, right? A lot of it is just, I would call it you'd be amazed about how many companies generate $100 million of revenue and are very unsophisticated in how they operate as a business. Meaning they have poor financial controls. They have no human resources. They don't really have a chief of operations. They may have a distribution warehouse. Like they may be distributing most of their stuff to Europe, but their distribution warehouse is in Kansas City, Missouri, right? So like a private equity firm will just go buy a warehouse in New Jersey and ship to Europe because that'll just be a lot more efficient for them. It's cheaper for them right? They don't have to go from Kansas City to the ports and Newark. And, these are simple things they can do and now you would be amazed, is what I'm saying, is if you saw it, you say, oh my God, this is so simple. But you can't blame a founder. You can't blame an owner because a founder might just be some person who's just really good at doing that one thing. And they're not really a business person, but they were a person with an idea and they created this idea and they made a business, but they're not really business savvy, you would think, There's people that are just interested in doing what they know to do, and they're not really focused on, EBITDA was 12 million this year versus 10. To them they're rich, so they're like, I made 10 million bucks this year. Oh, I could have made 15. Okay, and then they think about the effort that has to go into that. Some people are managers, Some people are just a founder. They're just doing a thing that's able to make them money. They're not there to be strategic in their thinking and how to operate and be more efficient. So private equity does put a little bit more efficiency into these type of companies. Sometimes, not all the time. But they generally know how to run it a little bit more efficiency. There's also things like, let's say I buy a lot of wheelchairs from a wheelchair manufacturer. And let's say that I have relationships with all of the hospitals in New Jersey. Okay? I get pricing. Remember we talked about Best Buy and monitors and stuff like that? I get pricing to buy wheelchairs and to sell them to hospitals in New Jersey. A private equity firm owns me, right? So I'm the founder. They paid me. I cashed out nice, but I'm still operating my business.
how would the private equity company be able to leverage pricing? What would they then do if they were to make an acquisition? They would buy what?
Another company does the same thing.
Or something similar. Maybe instead of more wheelchairs, it's hospital beds. Maybe it's gowns, you know. So and then why? Because then they can go to that distributor and say, hey, now we bought a business that sells gowns to the hospitals. And now they're not just New Jersey, they're in Michigan and they're in Florida and they're in Tennessee. And now we have a bigger market, right? We can get better pricing. So now they've just made that New Jersey wheelchair selling business supplier profitable like that. Because they know that, oh, we can get better pricing. We already own 5 other companies that sells this stuff. We know that we can get that for $100 a wheelchair where you're paying $200 a wheelchair. So you see where they can become a little bit more efficient in their profitability. And you can see how they can drive EBITDA this way, like this. That they can do things like that. All right, so conceptually, this all makes sense to everybody? Okay, great. Okay, leverage buyouts, leverage finance, very important part of the private equity markets, because without the debt, they can't get the returns. And I don't know if the private equity, you know, if private equity only used cash, I don't know if they would even be like I don't think there'd be a private equity market without the debt, right? Like you would need the debt to get those sort of returns. Otherwise, I don't know if there's enough appetite for that type of risk that the investors have to take. Does anybody have any questions right here about this stuff? Anything here that they don't see or understand? Actually, just take 2 minutes and just read these bullets for yourself. Take 2 minutes and read it. And if you don't understand a term, let me know. So this is just below investment grade, meaning anything with so different credit agencies. You have S&P, you have Moody's, and Fitch, I think is the third one. They have different ratings for different securities. So below investment grade means anything with BA1/BB plus or lower. So they have rankings here. I'm going to show you that later, but you know, they have rankings on ratings on these loans. You know, their ability to actually do a good job of that is probably pretty questionable, but you know, again, I'm not here to like relive The Big Short, you know. I just take it for what it's worth, you know. That's what they do for a living. Anything else here? Good? Okay. So here you go. So this is what you were just asking. Where do leverage finance securities fall? Where does the debt that finances private equity fall? All right? Here. Now, where do you think Apple is on this realm? Right. They're at the top, right? Where's that Macy's debt that we talked about, most likely? Probably still might be investment grade, but it's border, right? But the Lev Fin market, the private equity debt is going to be there. Now, I don't know if I really did a good job of this, but if you're like triple C's and D's, and like this is really a busted credit, I would say. So you go C, 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 and D. there's a lot more issues that are going on. Triple C, technically, you're not really like defaulting yet, but maybe the expectation is you may. If you're D, you've defaulted most likely, or you're about to default on your debt. Like you're ready to default, you can't pay your debt anymore. It's a really bad situation going on. So like the private equity firm probably is not going to be involved anymore because now the debt holders own the business, and we'll kind of get into that a little bit more. This is pretty good. This gives you just a few data points on how the ratings categories look at credit ratings. And these are the things we talked about, like look, debt to EBITDA on the bottom left. So the second bucket down, the second table, all the way to the left, debt to EBITDA, right? The more debt to EBITDA, the worse the rating. The less debt to EBITDA, the better the rating. Make sense? Remember we looked at that, we looked at it as a free cash flow as a percent of debt. Remember that? That's higher it went, better the rating. Lower the went, worse it was, worse the rating. And then CapEx depreciation, we didn't really think about it that way, but that's fine. EBITDA to, so they call it EBITDA, so they don't include depreciation because they're looking at it as a real cost. So this is a good example of that. The is amortization, amortization on intangible assets. Maybe not things that need to be reinvested every single year. For a technology company, probably, but not for an industrials company, for instance. So they're taking out the D, meaning they're including that cost as real cash cost. Because they're rating agencies. They want to be a little bit more conservative. And this is a good one. I mean, I don't know what that one all the way to the right tells you. Revenue volatility. I get it conceptually that the more volatile your ratings revenue is, if you're going from 100 million in revenue to 50 to 200 to 20, like that's going to be riskier. But I don't really see a fact pattern there. Meaning, like 10.8 and 11.2 is a percentage points probably. I don't know, but 10.8 to 11.2 and then 17 and 14. It doesn't really tell me much. I mean, just looking at the numbers doesn't really say much to me. Okay, we talked about this, but it'll be good just to kind of, again, talk about it now. This are going to be a little bit more outdated, but asset-backed securities, we talked about revolvers. You're going to be LIBOR plus 150, LIBOR plus 250. That's going to be the range, maybe 350 today. Things are a little bit wider. First liens, term loans, that's going to be a little bit higher today, maybe 5 to 6, 5 to 7% now, and not 4 to 5 generally. Leverage. Net debt to EBITDA is going to be 3 to 4 times typically for the first lien. And then loan to value. Where does our loan sit in the capital structure relative to our enterprise value? So just quick math. If I told you that a company has $100 million of debt we're going to take in a $200 million enterprise value, what's our loan to value? 100 million in debt in a $200 million company. 50%, right? So our loan to value, our loan relative to the value of the firm is 50%. So typically they're looking for a first lien about 30 to 45%. This is a simple debt structure. First lien and revolver. EBITDA is 50 million here. Revolving debt is 50 million. First lien is 150, but that says 4. Why? Why does that say 4? Because 150 over 50 is 3, right? So why is it 4? The total, right? Because when you think about leverage, it's through the security, through it, meaning that, remember we talked about collateral, we talked about first rights on assets, we talked about who gets their money first in a liquidation, who gets their money first in a bankruptcy, or a liquidation, right? Because bankruptcy don't necessarily, that's not going to happen. You got to think about it that it has to be included in your total debt calculation. All right. So I'm first and second, so your total debt is 200. It would be like if you took a mortgage out on your home and you had $50,000 of debt mortgage, and then you went and took out a home equity line of credit. So then you took out another 10,000, well, your debt is 60. So somebody says, well, who has seniority? Let's say the revolver has seniority for your line of credit is first. So you would have to say, well, that's true. We have 60 total. You just don't want to say 150. Does that make sense? So you get the math. You know how that 4 is being calculated? Everyone does? Okay, you're going to have to do it. So coupon, LIBOR, it just says here 250, but that's fine. Plus the spread and the coupon. So how's the coupon being calculated here? Just pick one of them. How's the 7% being calculated?
5 plus spread.
Exactly. So it's LIBOR plus spread. Base rate plus the spread. Remember, we're talking about base rates, we're talking about treasuries, we're talking about LIBOR. LIBOR just generally used as a floating rate, it's variable. If LIBOR falls below 1%, where it is today, it's below 1%, then the lenders always say we got a floor of 1%. So no matter if LIBOR is negative, we're going to at least get 1% as a floor plus a spread. Okay. So here, can they afford the debt? Simple yes or no. This is the coverage. This is EBITDA over interest. Yes, they can afford it. So we have this investment, 50 million of EBITDA, 10 times multiple, $500 million of value. Revolving debt is 50 million. Our residual value, now we got to think of this as a waterfall, okay? Think about it as waterfall, right? When you actually, like real waterfall, water's falling down. When you think about value of a business, you think about equity. Where does the equity lie? At the bottom, right? Because enterprise value is the total value, and then the debt comes next, right? They have next claim on the business. So if we went to bankruptcy tomorrow, I keep saying bankruptcy. We went to foreclosure, foreclosing. Who will get the money first, debt or the equity holders? What's that? Debt holders. Debt holders are going to come first. So when you're thinking about money left over, this is just called a waterfall. It's our enterprise value minus our revolving debt we owe is 50. Our residual value left over is 450. So if there was no more debt in the structure, if this was just blank, what would the equity value be? 450, because that's what's left over, right? Simple. Now, let's look at the situation. Now, debt, the revolving debt is covered 10 times here, right? So what does this mean? This means that our value of our business is 10 times the value of our debt. And this is not leverage. This is just coverage. How much coverage do we have? How much is the business worth? Just like your home and a mortgage. If our home is worth $500,000 and our debt is $250, we're 2 times covered, right? So the bank knows, okay, even if they stop paying, we could probably take them a foreclosure, take over, and then sell the home, and we're going to get our money back. It's like you can't get 10 times the revolver, but you can get your money back. That's what you got to do. Now, EBITDA declines 75%. You see here too, we said there's 450 left over. So the coverage for the first lien, because our next is 3 times, right? Okay, we get that. Now EBITDA declines 75%. What happens? Revolver now 2.5 times. We're left over at 75. Is the first lien covered anymore? No. Right. So what's the first lien worth in this situation? Half. So if they went to a foreclosure process and they had to sell off, EBITDA went really down and they had to sell the business, who's out of money here? First lien's out, right? And the revolver is good. So does this make sense about risk and return, or why the revolver would be a lower interest rate relative to the first lien? Okay, good. Any questions on this? Very important topics. All right. Second lien, subordinated debt. Subordinated, just below someone else, right? A senior loan that holds a secondary claim on the collateral behind the first lien. But they're slightly less stringent on covenant package. So a covenant package, you think of it as metrics that your company has to hit, not to foreclose on the loan, not to have the lender come and foreclose on you. So that would be like, and I just like to use the mortgage examples because they're simple. It would be like the Wells Fargo saying, you have to make every interest payment. And if you didn't make an interest payment for 1 month, we're going to come and take your house. That would be a covenant. Instead, what they do, lenders use leverage as a covenant. So they say, okay, you're allowed up to 4 times leverage. Your debt to EBITDA can be 4. If you start to go above 4, then we get to re-engage you. And what does that mean? They don't foreclose yet. Because remember we talked about relationships? The lenders and the private equity firms, you don't want to be cut out from them. So they want to re-engage them. What's going on? How can we help? What are we doing? What, the private equity firm might say, oh, we need to delay some payments for a couple months because we're having issues with the business. So you might do that. And then 3 months goes by and they can no longer make the payment. Then there might be a little bit more stringent things might start to happen. Or they might just foreclose on the loan if they just feel like it's not a good situation. In this situation, you're going to have higher leverage and higher loan to value, right? Because you're going further in the capital structure. Yes.
So, have you seen the replacement yet for LIBOR? Like, is that something that is sort of using that pretty much across the board?
Yeah, that's just still being used across the board.
Okay. Well, obviously, they're trying to replace LIBOR.
Yeah, we haven't had much discussion with it. It's just that given where rates are, that they are so low, everyone's using 1% anyway. So no matter what the replacement is, it'll be 25 basis points, 30 basis points. No leverage lender is going to be able to take that on such a low leverage level. I mean, low return level.
Okay, and now going back to the VRC days, so how many years ago? 5 years. How much have you seen the number change on the spreads over that time?
So the spreads have gone up since. So when I started working in valuation debt, it started that spreads were wider, so we had bigger spreads. As I worked there, spreads collapsed a little bit, right? They shrunk. And now today, because after COVID, they widened again. So again, why would they widen because of COVID? Why would spreads widen? Why do people want more return for the risk they take? Yeah.
Wouldn't it be like a lot of it revolves around the lower interest rates, like you yield, like you can't get money anyplace else, so you take a bigger risk. This, the best bank, commercial bank gets you 0.5%. So it's like anything is better than that.
That's true. There is some reach for yield, and people want more. But why can't a company just go and borrow at the same spreads? Why would they have to pay you more because of COVID?
Oh, uncertainty.
Exactly, and risk, right? Make sense? Like they can't just go out and borrow money at the same they're borrowing if their business is not cut in half. If the doors are closed, if they're a restaurant, right? They're 25% capacity. They can't go borrow at the same rates, right? Okay. Any other thoughts on that, Peter? Any other thoughts? No. Okay. So this is a similar scenario with the second lien now. This is the same thing with coverage, affordability statistics, spreads. You can see here, there's also things called intercredit spreads, meaning what is the spread? These don't do between a revolver, it's very asset backed. But what's the spread between a first lien and a second lien? Why is there a spread between two securities like that? What have we talked about that would increase risk as you have more debt, right? Leverage. Let's just go at leverage. So why do you need more? Why do you need more interest, more spread, more return as you get deeper in the capital structure? Yeah,
Because those are people who might not get paid back.
exactly. Did everybody hear that? Okay. People may not get paid back if there's an issue and they go through bankruptcy. And also they're just generally taking more risk, right? It just keeps coming back. I just probably said the word risk 100 times today because it's all that this is based on. So when you think about these things, just try to think of it about it that way. And in this situation, this is the decline again of EBITDA, and you can see what happens to the coverage levels or the interest, the EBITDA to interest. They're still able to pay the revolver. We're still able to pay the first lien. We're no longer able to pay the second lien, right? So what happens in this situation? Second lien's going to go and try to do something to re-engage their client and say, hey, we got to try to get some better payments here. What's going on? They may negotiate with the first lien, which is interesting because they may have relationships with other banks and they like to coming together on a deal. So they may go to you and say, hey, how about you allow us to get some more cash flow right now? You know, you've been covered here. Let us get repaid a little bit so we can kind of keep our working relationship going. And then there's amendments and there's rewriting of legal agreements, and it's a process, but this is the kind of stuff that will occur. I just can't see this top here, so let me just oh, okay, this is the same concept. Now we added in a second lien. So on the left side, this is everything is good. We see the leverage, and here we see the EBITDA decline. So how much was left over for the first lien? 50%. How much is left over for the second lien? 0. This should say second lien, not first lien. That's 0. A unitranche. What is a unitranche? A unitranche simply is one piece of debt that comes from one lender that is going to be a mix of that first lien and second lien pricing. So why would somebody want a unitranche rather than just getting a first lien and a second lien? Yeah.
Spread the risk around, especially if it's one group.
If it's one group, we're good. From a operator's perspective, sometimes they just like to deal with one company. They don't want to deal with 2 different banks or 2 different funds who are providing debt. They don't want to do that. What's that? Yeah, so some have rights and some don't. It just matters how they structure the deal. So this is a single term loan, similar leverage to a typical first and second lien. Leverage is higher than a first lien. And due to the leverage through a typical second lien, the unitranche coupon is similar to a blended all-in debt capital of the first and second lien. So remember we talked about the first lien was like 4% and the second lien was 6%. So unitranche is going to fall somewhere around 5. So typically the debt cost of capital to the company shouldn't really change. And it's a little bit easier for them to make a deal. They don't want to have to go through 2 different sources of funding. They want to go through one. So Aries, who one of the William Patterson students is now working. Is he working there now? Okay. So Aries created this unitranche structure. They were based in New York. They have a big private credit arm. They have a private equity arm as well. They created the unitranche structure. So the rest of the market doesn't like this because they feel like they've kind of squeezed out a lot of the competition because people don't like to do this. They like to have a first lien, second lien. I'm a first lien lender. That's what I want to give. I'm a second lien lender. I don't want to give. They don't like this blended deal that they've kind of created a structure out of nowhere. And, you know, they really kind of took over the market with this. So, because it's better for the operator. They don't have to pay 2 people. They don't have to go through 2 sources of funding. It's just one. So it just makes it easier to get a deal done too.
I think they're more mezzanine, so they're declining second.
Who? The unitranche?
Yeah.
No, the unitranche typically doesn't have anybody ahead of them. They may have a first lien and a unitranche, and if that's the case, then they're going to get higher percentage or higher interest rate. There might be a revolver there. That's it. But they don't have anybody else in the structure. It's usually just them.
Oh, okay.
You got to remember too, getting a deal done. It's like everyone's on a different time frame. Like I'm the private equity firm. I'm gonna go talk to the investment banker, right? Like so I was an investment banker. So the PE shop would go through all this diligence. While they're doing diligence with me, the banker would go through my models and talk about a company. Now they got to go to lenders. If they had to go to 2 lenders or 3 lenders, everybody's got to get the wiring done. Everyone's got to do their due diligence. Everyone's got to ask their questions. Everyone's got to build their models. So you can imagine you, Joe, or the PE shop, you want to talk to 3 different lenders right now about 3 different tranches in your security, would you rather have one guy have a conversation? Right. It's literally your time. It's sending documents, getting legal. It's so much that's got to get done behind the scenes. I always say now the sausage making is a lot harder when you see it behind the scenes. Everyone looks at this whole world and sees it after it's all done and just thinks it's kind of simple, but there's just so much that goes on. It's mind blowing. We had a deal. It was just as an example, it was a autism centers. So they did outsource autism teaching. So they would send autistic teachers, they're called ABAs, to schools to help autistic children learn. And they had autistic centers that the parents would go and bring their children to help with their learning. When we got to a final buyer, it was like $300 million deal. The buyer sent us a diligence list. And how many points do you think were on that diligence list? How many questions? What do you think it was? I don't know, just guess. Over 100. I'm like, what do you think? Yeah, we're 350. So who do you think who do you think answers that? Or who do you think has to delegate those answers? Right, like the banker, right? So that's my job. It's like, okay, what goes to legal? What goes to accounting? What do I got to do? I'm the bank. Like there's a lot of those questions I'm going to answer. So you can imagine how long does that take to answer 350 diligence questions? So it took from November till March. That was just answering questions. Because then there's questions on top of questions, right? So now you answer those questions, and now they get data. Now they can actually analyze what you're presenting them. Oh, well, why is this like this? Or why is this like this? Now they hire an accounting firm. They hire quality of earnings people. Those people are going to take this information. They hire lawyers. Lawyers get paid to ask questions, right? Lawyers get paid to book hours. Worst thing, listening to 2 M&A lawyers have a discussion is like you're just like, cut to the chase, dude. Come on, questions upon questions, and why is this? And it's, that's why I say like behind the scenes, it's like just wild. It's good to go through a deal process and to see all that happen because you appreciate what actually goes down to get a deal across, and be done. You watch CNBC in the morning and they flash, oh, some company bought some other company, And this is why bankers work so much, That's another thing. You're going to go to JP Morgan, you're going to see all this. So it's like, people say, why do investment bankers work so hard? Why do they work so long? Why is it so many hours? It's because there's so much that has to get done in a short amount of time. Everybody wants to get a deal done and get it closed, and you're advising, and it's just some of the work. You're on calls during the day. You might not even start working till 6 o'clock at night because you've been on all these calls all day. Like you've never got to the actual work you have to do. You've been pulled into this meeting and that meeting and this meeting, and we're looking at this deal, and these guys have questions. Do you answer the lawyer's questions first? Do you answer the accountant's questions first? How about your client? Do you answer their questions first? How about your managing director? How about your direct manager? Who do you answer first? How do you delegate this time? So a lot of that, which you should think about, because it's a lot of just delegating. What's important? What's a priority? And that's tip. I feel like there's a light bulb went off. Tip. Prioritize everything when you work. Figure out what's priority. There are people you're going to work with who make everything the priority. So those people you sniff out like real quick, like, oh, that guy or that girl, they always make their work the most important, So you got to be able to delegate in your own head, prioritize. Okay, what do I need to do today? What do I need to do tomorrow? What do I need to do next week? What can wait and what can't wait? Super, super, super important. Seller note. What do you think that means? Seller note. Just in that word. Let's call it a seller loan. What's a seller loan? What do you think that means? Just from the word, seller loan. Exactly. That's it. So simple. The loan provided by the seller. In certain situations, the seller will take a loan or lend for the acquisition of their own business. Because what they'll do is say, okay, you want to buy my business for 100 million, I'll help finance this deal for you. So you're going to pay me 100 million for the company. So you're going to give me 90, and then I'm going to give you in return a loan for $10 million. Now on that 10 million, you owe me 10% a year for 5 years. This is called seller financing. The seller will help finance his own acquisition. Why would that happen? Maybe the buyer can't get all the financing they need. Maybe the buyer wants the seller to kind of still have, they call it skin in the game. They still want to be involved. They don't want them to just take a check and leave. Because this gives the seller a reason to make sure that company continues to do well. Does that make sense? Yeah.
It's like similar to the lockup thing in the stacks, right?
Right. Keep them around longer. They can't just blow out of a position. The other thing too is equity. Sometimes management. Yeah. A lot of the times in a deal, the seller has to take an equity position. They have to. 25%. You got to own 25% of the equity. Because the buyer says, I need you around. You're the founder. You started this company. I need you to work every day. I need you to come to work. I need you to still help build this business. So if, let's say it's a $100 million deal and we give you 75 million, you're still going to be on the hook in our business to help us grow it. And then when we sell a second time, because private equity tries to sell it again 5 years from now, that's when you're going to completely cash out. Does that make sense? Okay. We're not going to get into those as much. Preferred equity. Preferred just has a higher claim than common. It's an equity position. They typically have PIK interest, paid in kind. Paid in kind is accrual interest, meaning if we borrow 100 million today in a preferred equity position, that's going to grow in principal value over time. So we're going to go from 100 to 110 to 120 to 130, but they're not going to pay cash for this, right? This is just growing in value. So that when they actually sell the business in the future, that person gets to recoup their money. Does that make sense? Okay. Great. Options, warrants, common, we can, unnecessary at this point. Okay. Capital structure. Okay. Did I? Okay, good. All right. So let's go to the slide 16 file. It says let's break into small groups, but COVID doesn't allow us to do that. So go to your slide 16 file. You have your inputs here. How would you structure this without knowing any other information? That's what I want you to do. So let's go to slide 16. Okay. We know the sales, multiple, leverage. You see the math in there. Spreads. What's the right coupon? Is it affordable? Is it not? You're all going to tell me. Okay. So you have a sheet there. You have these basic inputs. Sorry. Okay, you got the inputs here. All right, I'm going to give you about 15, 20 minutes. 15 minutes.
Slide 16.
Slide 16.
Slide 16, everyone have?
Does everybody have it?
No. All right, I'll forward this to Aaron and Ash.
You don't have it? You have it?
Yeah.
You have it?
Yeah.
Okay.
I'll be
Do you have it?
Yeah.
You have it? All right. Hallie? Great. Okay. You have revenue, EBITDA, enterprise value. How would you structure this without knowing any other information? You gotta think about what's the leverage level is gonna be. What's the spreads gonna be? Is it affordable, right? What's the multiple you're paying for this business? What's the loan to value for this business? Think it through, because you gotta think about it. If you're an analyst and you're working at a firm, you're just gonna get this stuff. So in my job right now, like I spent all day yesterday structuring a deal. This was my job. Structure the deal. Nobody gives you the structure. If you're originating the deal from scratch, you're not going to be structuring it. If it's a private equity backed deal, you may get terms from the private equity firm, like, hey, we want this to be 4 times levered. We want, 6, but you still got to structure it to make sure that it makes sense. All right. So right about that. If you have questions, it's not a test, so you have questions, ask each other. You can ask me when I come back. This isn't a test. Just want to make sure you understand it.
Yep, I remember.
How's everybody doing so far? How's everybody feeling?
Good, bad, ugly, what? The good, bad, and the ugly? Is it more of the ugly?
I have a question.
Yeah,
I mean, this is kind of like,
yeah, let me pull it up. Okay,
C3, current fiscal year, is that a multiple or is that going?
yeah,
It's multiple. So is that current fiscal year?
we're just using 100 million, right? I think that's what the thing said. Yeah, 100 million, 25 million EBITDA. So let's just think. Oh,
Can I ask you a question? See, that might seem really rudimentary, right? How, like, I'm working with this stuff and seeing it, not knowing like all the math behind it. A lot of these are, I mean, there's little tweaks with them, with the interest and the revenue with size. A lot of them are almost like boilerplate, like how they're gonna grow it, right, from a loss to a gain over time, right? Like I mean, it really is like a road show, right? I mean, like just the fundamental piece of it, right?
what do you mean exactly? Sorry, that EBITDA is supposed to be the EBITDA number. So this should just be EBITDA. All right, sorry, what were you saying?
And the fact that like very few of like the private equity deals start off as like something really profitable. It's you have to make it profitable, right? So like
No.
you're gonna show a loss, and then a transition to profitability to exit at some point, correct?
No, they always want to buy profit. Yeah, they always want to buy profitable businesses. And why do we know that? Because they need debt to buy that, to make the acquisition. So they got to be profitable. They typically like to partner with good management teams or companies that are good that just need some extra help. There is a public market, the private market, private equity is a little bit different. If it's, Kraft Heinz and they own, Oscar Mayer Wiener and ketchup and cheese, they may want to take that was public and make it private. And that might not be doing well, but they're going to kind of fix that up to make it better. But generally, they want to be profitable businesses because they got to leverage them. Because the lenders will never give them money if they're not profit.
Or something that's a good idea, and it might be losing money, but like the small biotech stuff that happens.
Yeah, those are different. Yeah.
Similar concept applied to different industries, so that can lose. And the fact that, like, let's say you have a drug that could do something with Alzheimer's, someone's willing to take
the risk, right? Because they know they can't get paid, and
That's what I saw, 'cause, like,
they know what they're funding.
that's what I saw, like UBI, it's a Taiwanese.
Yeah.
And they have a real evidence in trials and, raising the money was hard, but it wasn't like, given how big a problem Alzheimer's is.
Right.
$1 trillion. Like 20.
Right. Yeah. Nobody can ever figure it out though, right? Alzheimer's.
I went to Europe and it's interesting. Like the best trial I saw was a guy called Edison. He was getting Europe blue time. It's just he was saying like it's like leaving like a peach out the sun and your brain shrinks, but if you keep the fat,
Right.
Mass in your brain, it would stop the plaque from interacting with the protein. And I didn't know a ton about it. Like the guy was ultra intelligent, and he's like, yeah. In fact, the crazy part is, he said, I have video of it. He's like, it's very interesting because it's the cheapest way.
Right.
But so it's preventative maintenance. So you have to give people insulin at 50 when they start to see the brain mass shrinking. But no modern medical, company, like no one's going to do that. Like they're not just going to say like we're going to spend money for preventive maintenance.
Yeah.
It's not the business model. But it was really sad, like seeing that there's a way like to, put it off and no one's interested.
Right.
At a low cost.
Mm.
It's,
Yeah.
that's why I started, realizing like how crazy some things are.
Right. Right.
And he has the data to back it. It's like 4,000 people in the one trial.
Oh wow. Yeah, that's impressive.
And also too, if you catch it like when, I forget what the stage, this is like in 2015, 16, within like, I think like 18 months, you can reverse some of that.
Okay.
Trials, but. You know,
Yeah.
It's my grandmother passed, she had that, it's like, well,
Yeah.
you know, I worry about it, 'cause it's in the family gene
Of
pool.
course.
Like, many people don't care about it.
Yeah, I know. Yeah.
There's also some other, you know, there's trials,
Oh.
you know, but it's all in Europe.
Of course. Yeah, of course.
The US would never
Yeah, I know.
business at that point. So,
All right, so at 100 of sales and 25 of EBITDA, and 200 of enterprise value, right? So we got these inputs in, so everybody at least do that. 100 of sales, 25 of EBITDA, 200 of enterprise value, all right? So let's start thinking about this now. What would be a first lien leverage? Typical. What did we talk about? The leverage, the debt to EBITDA. What was a normal number? Not the 4, what did you say? 4 to 6 times. Okay, but what did you pick? What did you say? 4 times. Okay, and then what about the second lien? Okay, but now if we did that, what happens here? This doesn't make sense, remember? Because this is through the debt. It's always got to be higher, right? Well, we can't do that because if we do 25 times, what happens? What's our equity worth? Right. So what did we say? If we did 8 times, what's our enterprise multiple? 8 right here. What's our LTV now at 8 times? Right? Is anybody going to lend to 100%? So what did we talk about? So far, right? We're guessing and checking, but this is fine. This is what we want to do. It doesn't. This isn't meant to be like, oh, get it one time. This is the idea because you're thinking now. Okay, that didn't make sense. How would you change this? Okay, this is 50% at 4 times. This is 100% at 8 times. It doesn't make sense. We can't lend to this. How would you change this? Which goes 6.75? Okay, still, what now? What's the leverage level? What's the LTV? Right, is that too high, right? What is it? 3 and 5. Okay, see, this is now we're getting there, right? So we went through like 4 iterations, but like 3 and 5 is better, right? Now, what's our next check? What else can we check here? Because what else we got to do? What are we missing? So can they afford it at those levels, right? So what's our spreads? What did we talk about? And let's make this instead of 2.5, let's just make this 1. Make it a little bit more market today. What was our spreads? What did we say? Not for the revolver. The revolver was 2. So let's say for okay, and then what are we going to be in the second lien? What did we say? Remember we talked about intercredit spreads, right? What's the intercredit spread? How much is normal? What did I say earlier? In the first lien, second lien. If you gave first lien LIBOR plus 400 basis points, what's the second lien? What was the intercredit difference? 400 basis points, remember? So what's 400 plus 400? Right. So 4% plus 4%, 8%, right? So let's say 8.5. Okay. So just looking at this, I mean, we've just done this now. This is your check. So what do we check? Basic checks we're doing interest coverage, right? Down here, this is the interest that's being calculated here. We'll go through the calcs. If EBITDA declines, we would think of this as a stress test, right? So let me see if anybody's still out there on Zoom. This is the stress test I'm thinking of right here. We're stressing this situation. And we're thinking, okay, if profitability declines 20%, 40%, are we still, how much do we go until we break? Well, we can decline 60% and we're still getting paid here, right? That's good. Our leverage is good. Our LTV looks maybe a little bit high. I don't know. You know, our affordability coverage looks good. But now let me ask you something. Let's say you weren't comfortable at 63%. Let's say the first lien, they're comfortable. First lien, they're different parties, different lenders. The first lien's good. They want to give LIBOR plus 450 at 3 times. They're comfortable. And to get the deal done, they do need the 50 million from you. They need $50 million. You've got to do it for 50. But you're worried because LTV is high, loan to value is high. What are you going to do here to offset some risk that you're taking, that you think you're taking? We're not going to change leverage. We're going to stick that along. What's your lever as a negotiator? You're negotiating. This is the art of the deal. You're sitting here and trying to make a deal here, but you need something to something to accompany the additional risk that you're taking. What is it?
Would that be in the spread?
Yes. What would you want? You got to be a shark here. What do you want?
Have a more greater spread?
Yes, which is a higher interest rate, right? Because you're taking on more.
More risk?
Exactly. Did we get that? So what are we going to do? Instead of 8.5, where are we going with this?
I think that's 9.
I don't know. You can negotiate. Remember, you like my relationship. We're friends. I took you out golfing. We'll go to a Knicks game. Take you out to dinner. Buy you a trip for your family. I mean, I don't know.
That'll be nice.
I'm just saying, I don't know what's right for you. I mean, you can think about these things. It's not just math, right? So what's it going to be? It's got to be higher than 850 then, right? But we said that's market. Market is 850. Market's 400 basis points. So what would you do to this? All right, yeah. So give me a number. Don't be scared. I'm not going to bite. Is it 10? Okay, so let's do 10. So now at 10, okay. So what goes up when you increase the interest rate? Right. And then what does that do? It reduces our what? Okay. And then a 60% of decline in EBITDA, are we still covered? We don't want this scenario to happen, but if you're from a lender's perspective, you got to think about risk. Lenders are all about downside risk. Everybody's going to tell you that things are good on the upside. Everything's going to be good. We're going to do really well. We're going to do great. Our company's going to be awesome. But you're worried about repayment, remember? So I think, I mean, are you comfortable with this? Are you not comfortable with this? What do you think? I mean, just give me yes or no. You said yeah. You said it, so you're fine. Joe, are you comfortable?
Yeah.
You are? Are you? You are? Are you? Peter, are you comfortable? Comfortable? Yes. Yes. Okay. Well, we're gonna go with the message. So we're all in unison here, and this is it. The deal gets done like this, right? This is actually what goes on. The investment team gets together. They're gonna present these things. You come together as a team. Hey, are we comfortable with this? There's something called an investment committee. We present it to a committee, literally, and we talk about this, and this is the conversation that goes on. Right? There might be a differing opinion. Right? He might be the holdout. I don't know about that. I think there's a lot more risk here than you think. But I'm comfortable with this. I think this is good. I think we've structured a good deal here. I think now there's more pieces to this. This is not it. There's excess cash flow sweeps. There's amortization. There's covenants. There's a lot more that goes on. But I just basics here. This is concepts. This is most important. Is the basics. So here we're comfortable. 3 by 5. Now let's say we did it this way. Now let's say they did 2, and then you would do it 4, right? What would have to then come down here if you were the second lien? So we reduce the LTV, we reduce the leverage. What would the private equity fund expect from you? What would they expect from you on rate?
You have to decrease.
decrease the rate, right? Because they would say, hey, why are you above market? Market's 8. Why are you giving me 10? This is normal leverage. What's the issue, right? That would be the conversation. So then this would go down. Oh. That would go down. Does that make sense, everyone? Good? Good, good, good? All right, awesome. All right, good. Okay. All right, let's go back here. This is how we did it before. Yeah, it was kind of similar. Yes, we did it 5 times, 3.5 to 5.25. You know, if the markets are a little bit riskier, you can give a little bit more. You know, it's a lot of it's market dictated. We talked about stressing the scenario, so we kind of did that already. Okay. Next step. So this, yeah.
Sorry.
Oh yeah. Sorry, Zoom. Let's see. Okay. We're now for today and then tomorrow, we're going to go through a real company. We're going to go through modeling the company, creating income statement, balance sheet, cash flow statement, deriving some valuation, and thinking about leverage and all that kind of stuff. So we're going to try to go through the whole kit caboodle. The odds of us finishing that all in you know, now obviously a little bit of time left today and then tomorrow, maybe slim, but if we work fast enough, we can. It's just you're all I don't, and I'm still, I wrap my head on what's the right way to do it. I don't think I'll figure it out. I don't want you to fall behind. You know, the idea is for you to do it, not for me to do it, because I know how to do it, right? I do it for a living. So it's like if I just fly through with this and I just do it, and then you're all just like, I don't know what the heck he just did, and I'm not even there. It's not a benefit for anybody. So we're gonna just walk through it slowly and try to get things done as fast as we can. You know, okay? So we don't have too much more time today, but what we're gonna do is you know, input financials and kind of go through comparable companies, and we should probably do that today. That we can kind of do today at least. So let me just pull up this.